everybody. Good afternoon. This is Alex Tapia with Aviation Retirement Strategies coming at you from our podcast studio here at the ARS National Headquarters atop the Atlantic Aviation Building at the George Bush Intercontinental Airport here in Houston, Texas. Today is Friday, May 13th, and just wanted to leave you guys with a weekend message after this crazy week that we've had. 2022 has been a pretty challenging year for investors so far. The S&P 500 index just had one of its worst Aprils in decades, and May is off to a pretty rocky start as well, as you all know. And bond investors haven't fared much better as rising interest rates have pushed down the bond prices. Bond losses have made the stock market volatility actually feel even worse than usual. Markets don't like uncertainty, but it's getting a pretty healthy dose of it this year for sure, because we're dealing with high inflation, tighter Federal Reserve monetary policy, COVID-19 shutdowns in China, a challenging global supply chain, and all the while we've got this war in Ukraine that continues on and on and on. More often than not, during times like this is when investing mistakes are made, and they take place during periods of elevated volatility. The most frequent one is trying to time the market by jumping in and out. So if you think about it, market timers have to get it right two times. They have to get it right going out, and they have to get it right going back in. And timing the return of the markets can be extremely difficult to pull off. Markets turn quickly, and missing even just one big update could have a significant reduction in your returns over time. The biggest daily gains tend to come in down markets, making them especially difficult to predict. Not timing the market may be much more beneficial for long-term investors. When markets are shaky, it can be helpful to look at the long-term fundamentals also that have provided really the foundation for positive returns for stocks and bonds over the long run. For stocks, gains depend on the ability of corporations to grow earnings, which they've continued to do so during the first quarter of the earnings season this year. The S&P 500 index, the largest 500 companies in the country, that index, their earnings per share are on track to increase 10% year over year. For bonds, the key fundamental has simply been the ability of borrowers to make the required payments. Corporations and corporations and consumers alike are enjoying both strong balance sheets and have the financial firepower to pay off their debts. So while the future is always uncertain, we truly believe that those fundamentals still remain in place this year and probably will continue to do so for quite a while. Even against a potentially supportive fundamental backdrop, the volatility we've seen in stocks this year is really not that unusual. Although negative returns for a full calendar year are pretty infrequent, corrections are actually fairly common. Since 1980, the S&P 500 has been negative for an entire calendar year only just 7 times. But the average decline within any year has been 14%. Midterm election years like this year have tended to see increased yearly volatility as well as the honeymoon period for a new president ends and the political uncertainty arises. Inflation can also be challenging. Years with inflation of over 5% have seen more frequent stock market declines in a typical year, and have been still higher more often than not. Even against a potentially supportive fundamental backdrop, the volatility we've seen in stocks this year is not unusual. Although the negative returns for a full calendar year are infrequent, corrections are actually fairly common. Since 1980, the S&P 500 has been negative for a calendar year just 7 times, but the average decline within any year has been 14%. Midterm elections have tended to see increased early year volatility as well as the honeymoon period for the new president ends, and then the political uncertainty starts to rise. Inflation can also be challenging. Years with inflation over 5% have seen more frequent stock market declines than any typical year, but stocks have still been higher more often than not. Amid the global economic and geopolitical uncertainty, the core domestic economy is really still quite stable. Weekly consumer spending data is above typical baseline levels. Job seekers are participating in a tight labor market with twice as many openings as unemployed people. Businesses are enjoying high profit margins despite cost pressures. The economy is expected to grow in the latter part of this year after a surprise contraction in the first quarter, though the growth path may be bumpy as monetary policy is recalibrated from exceedingly loose to moderately tight, and consumers and businesses adjust to higher borrowing costs. Our base case is still for the above-trend economic growth in 2022. We believe patient investors stand a much better chance of meeting their long-term goals. No one has a crystal ball, but at the lower valuations, history suggests the chances of above-average returns going forward may be rising. It's tough to do during times like this, but we encourage long-term investors to stick to their game and stay the course with the plan that we've set out for you. So for now, we'd like to ask you to go enjoy your weekend. Hopefully the stock market will actually close here on an update. It's almost closing time for the market. We certainly need a day like today after the week that we've had. Hopefully that continues on into next week as well. But as always, if you have any questions, please feel free to reach out anytime. We're always available, myself, Andrew, Austin, or anybody here at the office. And we would look forward to hearing from you. But thanks again for listening, and we will be talking to you soon.